Hi, everybody. Welcome to Friday's Focus on Finances. My name is Jamie Fleming, and today we're going to be talking about if you're missing out on this really smart way to save for retirement. We know statistically that 75% of eligible young people are missing out on this. Employers are increasingly offering a valuable retirement savings tool to workers. In addition to the traditional 401k plans, about 8 in 10 workplaces now let workers invest in a Roth 401k. This is actually up from 37% that offered this same option in 2010. So 11 years later, we have 80% of workplaces offering 401ks, also offering the Roth 401k. But here's the interesting thing: workers aren't actually beating down the doors to take them up on this option. Only about a quarter of 401k investors opt to contribute to a Roth plan. And this number has actually remained fairly steady over the years. This is according to the American Retirement Association. So we've gone from a third of the plans offering a Roth 401k up to 80%, yet only about 25% of employees are taking advantage of this, regardless if it was at the third of the plans offering it or the 80% of the plans offering it. So if your workplace is among those that offer a Roth, ignoring it could mean giving up on a powerful tool for building long-term wealth. Anything that can help you build wealth tax-free in this tax environment we're in currently is a really good move on your part. And although there are no guarantees concerning what you'll pay in taxes down the line, for many young investors who can opt in, the Roth 401k could actually be a slam dunk. So how does the Roth 401k retirement accounts work? So we've talked a lot about Roths, the Roth IRAs, Roth conversions, and even mega Roth conversions. So it'll be good to dive in a little deeper today about how the Roth 401k retirement accounts work, because there are some slight nuances that are different from your Roth IRA that most people are familiar with. So traditional 401ks come with an upfront tax advantage that you won't get with a Roth 401k. Contributions to traditional plans are made with pre-tax money and count against your taxable income for the year that they're made. That means if you earn $89,000 a year, for example, and you make a $19,000 contribution to your traditional 401k plan, you're taxed on $70,000 worth of income versus $89,000. So in exchange for this upfront benefit, you'll owe taxes on the entire amount of your portfolio when you withdraw the money in retirement. Roth 401ks turn this dynamic on its head. You fund these accounts with money you've already paid taxes on, and your investments within them grow tax-free. Provided you're 59 and a half and have held the account for at least 5 years, you can withdraw your contributions and earnings without owing another dime to the federal government. So this is a huge, huge benefit. Let's look at Roth 401ks versus Roth IRAs so you can see the difference and why this is an important tool for you to consider. If you think the rules around the pre-tax contribution for 401k sound familiar, you're absolutely right. They're the same ones that apply to Roth IRAs if we look at the Roth 401k. But the Roth 401k bears a few distinct differences. Unlike Roth IRAs, the accounts offered through your workplace don't come with an income limit. So you can contribute regardless of your salary. This is a huge distinction between the Roth 401k and the Roth IRA. Many people in higher incomes do not qualify because of the income limitations to contribute to a Roth IRA. But if you have a Roth 401k available to you, there are no salary limitations. And here's the interesting thing too: you can contribute quite a bit more. So for 2021, you can contribute up to $19,500 to a 401k, Roth, or traditional, with an additional $6,500 catch-up contribution if you're age 50 or older. The maximum contributions to a Roth this year, just your standard Roth IRA is $6,000 plus another $1,000 for the 50 and up population. So you can see it's a significant benefit to be able to contribute to the Roth 401k. Because they're offered by your workplace, Roth 401ks do come with some stipulations that you won't encounter with the Roth IRA. For one, unless you're still an employee, you don't own at least 5% of the sponsoring company, you must begin taking distributions from your Roth 401k account once you reach the age of 72, or you face a penalty from the IRS. If you remember in prior conversations, your 401k penalty, if you don't take out the required minimum distribution, is a 50% penalty on the amount that you should have taken out. But with the Roth 401k, even though this stipulation is also true, there's an easy fix to this. There's an easy way to get around it. As long as we get out of the plan, and to do this, we simply roll this into a Roth IRA before you're 72, you'll be fine and avoid the IRS dictating when and how much you're required to take. Because unlike the Roth 401k, the Roth IRA does not have a required minimum distribution stipulation to it. Roth 401ks are less flexible than Roth IRAs, and here's how. While you can withdraw your contributions at any time from a Roth IRA without tax or penalty, early withdrawals from a Roth 401k come with that premature withdrawal penalty of 10%, just as if you were to take money out of a traditional IRA or a traditional 401k plan before age 59 and a half. So here's why it could be wise to consider a Roth 401k plan. Many investors favor the traditional 401k because it offers a form of immediate gratification, right? The IRS has hung this carrot out there for years, which makes it one of the most popular ways for people to save for their retirement and their financial future. They're giving you a deduction on the seed, the amount that you're putting in, so that they can tax the crop later on. And this is an analogy I use all the time. Do you want to pay taxes on the seed, the smaller amount, or on the crop, the larger amount? And people think, I want my deduction today. It's very attractive. But the problem is not looking at the long game to see what it will look like when you start withdrawing the funds. I think statistically, they say for employees that put monies away into their pre-tax 401k account over a 25 to 30 year period, that they're getting that small deduction, right? You're getting a tax deduction every year in the same year you're making the contribution. The interesting thing is when they go to pull the money out at retirement, this larger portfolio of funds, which is 100% taxable, they say the IRS recoups all the taxes that you've gotten, the deductions that took you 25 to 30 years to get, that they get all that money back within a 5 to 7 year period when you start taking withdrawals. And then they continue to get the tax on those funds as you take the money out. But the break even, it's taking you 25 to 30 years to get these deductions. And that current benefit, the IRS recoups in 5 to 7 years. That's crazy. So you can see why they make it such a popular immediate gratification today for you. But in the end, they're making a ton more money. So foregoing the tax break today can net you huge gains down the road, depending on your financial situation. The whole decision is a bet on today's tax rates versus future tax rates. And the odds are heavily in your favor if you choose a Roth. The reasoning behind the choice comes down to when you'll pay taxes on your investments. Because Roth money is taxed up front, you're theoretically coming out ahead if you expect to pay lower taxes now than you will at retirement time. That may be the case for two reasons. One is the advancement in your career. For the most part, younger people are starting their careers in lower tax brackets, and those upfront deductions aren't worth as much. If you take the tax deduction now, you end up paying for it much later in life when the rate you pay could be much higher. Even if you don't ascend tax brackets over the course of your career, the government could still potentially hike tax rates. Historically speaking, these are still the lowest rates many people will see in their lifetime. From 1946 through 1964, when the boomers were born, the top federal tax rates exceeded 90% in every year but one. People always complain about taxes, but these are really the good old days right now when it comes to tax brackets. There are investors for whom electing a traditional 401k over a Roth makes sense, such as higher earners who expect to fall into lower tax brackets in retirement. And for some investors, it may make sense to stick with a traditional plan and then convert their account to a Roth account via a one-time taxable event in retirement, though the long-term availability of this strategy is currently up for debate in Congress. So what's available to do today may not be available 5, 10, 20 years down the road. Still, investing at least some of your retirement savings in a Roth account is a potentially valuable move for many young people. Even if mathematically you should invest in a traditional 401k, in doing so, you're still growing a tax debt for later on in life. And who wants to pay taxes in retirement? Or at least who wants to pay the maximum amount of taxes in retirement? And if you go with a Roth and lose, meaning you didn't make the right choice as far as tax brackets, your consolation prize is that you've locked in a 0% tax rate on your retirement savings. That's not a bad worst case scenario to consider. So you can see there's a lot of things to consider even when we're looking at Roth IRAs, traditional 401k plans, and now, as we discussed today, Roth 401k plans, which is such a enormous tool, especially, like I said, for our younger workers. But even if you have 20 to 25 years ready for before you're retiring, that's time under your belt that you can let these monies grow tax deferred and come out tax free. So you want to do some calculations and some numbers. This is why financial planning is such an important piece of people's financial future success. If you don't know what your numbers are, how do you know which way to go? If you want to know how some of these strategies could work for you, take advantage of our complimentary consultation. We would love to work through the numbers, come up with strategies for you so that you could see how your monies will work for you. Don't make your money work harder than it needs to. So look at all your options and then deploy a plan to make them work. Thanks, everybody. Have a great weekend, and we'll see you next week on Friday's Focus on Finances.